In early April 2025, President Donald Trump enacted a series of sweeping tariffs, including a 104% levy on Chinese imports and a baseline 10% tariff on goods from most other countries. Given Trump's long-standing rhetoric on trade imbalances and explicit warnings in the preceding months, we anticipated these measures. Yet, financial markets reacted with pronounced volatility when the tariffs took effect. Major indices such as the S&P 500 and the Nasdaq experienced dramatic swings, with the Nasdaq surging 12%, its most significant gain since 2001, following the announcement of a 90-day pause on many tariffs. This turbulence highlights a perplexing phenomenon. Markets often fail to effectively price in risks, even when telegraphed well in advance. This video delves into the reasons behind this apparent disconnect, exploring the cognitive biases, structural incentives, and modeling limitations that hinder analysts and investors from accurately forecasting and integrating downside risks into market valuations. A fundamental factor is the inherent optimism bias is prevalent among analysts and investors. There is a natural tendency to favor positive outcomes and underestimate the likelihood of adverse events. This bias can lead to the dismissal or downplaying of clear warning signs, such as the explicit intentions expressed by the Trump administration regarding trade policies. Moreover, the phenomenon of anchoring plays a role. In this situation, individuals rely heavily on initial information, for example, a stable trade environment, and are slow to adjust their perspectives in light of new data, indicating potential disruptions. The professional environment for analysts often discourages contrarian views, especially those predicting significant downturns. Forecasts that deviate from the consensus, particularly pessimistic ones, can be met with skepticism or resistance from peers and superiors. This creates a disincentive to model and communicate potential downside scenarios, even when evidence suggests they are plausible. Additionally, there is a career risk associated with being wrong in a non-consensus direction. An analyst who predicts a downturn that does not materialize may face reputational damage, whereas aligning with the consensus, even if incorrect, offers a form of professional safety in numbers. Traditional financial models are primarily quantitative, focusing on tangible metrics such as earnings, interest rates, and historical volatility. However, they cannot often integrate qualitative factors like market sentiment, political rhetoric, and behavioral responses. The 2025 tariff scenario exemplifies this gap, where existing models did not adequately capture the market's emotional and psychological reactions to policy announcements. Furthermore, these models typically assume rational behavior and efficient markets, assumptions that do not always hold in real-world scenarios where sentiment and perception can drive market movements as much as, if not more than, fundamentals. George Soros introduced the concept of reflexivity, which highlights the feedback loop between perception and reality in financial markets. In the context of the 2025 tariffs, the anticipation of economic disruption led to market sell-offs, affecting business confidence and economic indicators, and thereby validating the initial negative sentiment. This self-reinforcing cycle demonstrates how sentiment can materially impact economic outcomes, a dynamic often overlooked in traditional modeling. The 2025 tariff episode underscores the need for a more nuanced approach to investment analysis, one that incorporates behavioral finance insights, acknowledges cognitive biases, and integrates qualitative factors into quantitative models. Investors should be aware of their biases, encourage diverse perspectives within analysis teams, and develop models that can accommodate nonlinear and sentiment-driven market behaviors. Additionally, scenario planning should extend beyond historical precedents to consider unprecedented events, recognizing that in a complex and interconnected global economy, the past is not always a reliable predictor of the future. The market's reaction to the 2025 tariff serves as a poignant reminder of the limitations inherent in traditional financial analysis and modeling. Analysts and investors can better navigate the complexities of modern financial markets by acknowledging and addressing cognitive biases, reevaluating structural incentives, and enhancing modeling techniques to incorporate sentiment and reflexivity. In doing so, they move closer to developing a more resilient and adaptive approach to risk assessment, one that is attuned to both the seen and the unforeseen,